Good afternoon, everyone. My name is Luke Tannen, and I am the president and CEO of Chicago Innovation, an organization that supports local innovators across industries, big companies, and startups through a variety of events and programs. We are also a very proud longtime partner and customer of Wintrust. And I would like to welcome you all to the fifth installment of Wintrust Wealth Management's panel discussion series on the economy and financial markets. Today's event, Rising Interest Rates and the Market, certainly a very timely topic, will focus on some of the ways in which our panelists have helped clients address the unique wealth management related challenges and opportunities brought about by the COVID-19 pandemic. Our moderator for today's discussion is Tom Zidar. Tom serves as chairman and CEO of Wintrust Wealth Management, which manages or administers $36 billion across 4 operating business units: asset management, trust, investments, and 1031 exchange. Our panelists today include Jason Turner, who is the Chief Investment Strategist and Head of Multi-Asset Strategy for Wintrust Asset Management Group. He regularly presents in the media and to professional conferences and works with portfolio managers to support institutional as well as private clients. And as the head of the Multi-Asset Strategy investment team, he's responsible for portfolio strategy, asset allocation, and for overseeing the firm's manager due diligence and selection efforts. And then also on our panel today is Nancy Studenroth, who is the Managing Director and Senior Fixed Income Portfolio Manager and is also with Wintrust Asset Management Group. She's responsible for research across multiple fixed income sectors and brings with her over 30 years of fixed income research and portfolio management experience. And with that, it is my absolute pleasure to turn things over to Tom.
Thanks, Luke, and welcome everybody in our audience, and welcome Nancy, Jason, our panelists today. We're excited to talk to you today about, as Luke mentioned, the pending higher interest rates that we see coming in the United States and related Fed actions that impact on the economy and the markets, and what our investor customers as well as business owners need to be thinking about in anticipation of those changes. So we're going to start with Jason. Good afternoon, Jason.
Good afternoon, Tom.
Good to have you here. So let's start with a check on the state of the economy, Jason. In terms of real GDP, the economy grew an incredible 5.7% last year, which is as high as it's been in nearly 40 years. But given the enormous economic disruption that COVID produced in 2020, comparing it year over year can be misleading. So where is real GDP relative to the pre-pandemic levels?
Yeah, pre-pandemic, for the decade or so before the pandemic started, we were growing at about 2.3% per year. So the 5.7% result from last year is indeed pretty stupendous. However, we got to take a look at it not just as percentage growth, but in terms of actual economic output. We were at about $19.2 trillion in GDP at the end of 2019. Today, we sit at about $19.8 trillion. That's a good amount of growth, but it's still about 1.5% short of where we would have been ex the pandemic had we just grown at that 2.3% rate. That shortfall of several $100 billion still leaves us on a path that we need to catch up, if you will, still in 2022 and 2023 to get back to the trend growth we saw for the decade before the pandemic.
So despite this huge number, we're still a little bit behind pace.
Still a little behind pace.
Got it. Okay. Well, Jason, let's turn to the audience for our first polling question of the afternoon. So Luke, if you could pull that up. And we're going to ask, what level of economic growth, again, in terms of GDP, do you expect in the audience for 2022? And we've got 4 options here: over 4%, 1 to 4%, flat, and then down 1 to 4. So please take a moment to click that radio button, and we'll come back to that in a second. Okay. So Jason, given this growth we talked about, what is your near-term outlook for 2022 economic growth?
So near-term outlook, we are still experiencing some tailwinds to the economy in terms of excess demand and some push to continue above trend GDP growth. However, we're facing a number of headwinds too. We hear a lot about inflation. We hear a lot about the employment markets. We also have pending Fed action coming. So with those headwinds and tailwinds, the combination, it's reasonable to see us reduce the growth rate from last year. So for 2022, I'd expect about 4% GDP growth. And then in 23 and beyond, returning to a trend level of growth between 2.5% for the out years.
Yeah, so you're saying this 4%. Let's see if we go back to the polling question, what the audience has come back with. So 63% say 1 to 4. So a little behind you here, Jason. And then the next high is flat is 18%, and then up over 4% is 17%. And nobody thinks down, 2% of the audience.
I appreciate the out.
Yeah, yeah. So a little behind your 4% number, but most people obviously think there's a strong economy ahead of us in 2022, which makes sense. Okay, so before we go, taking that into consideration and staying on the state of the economy, Jason, a really hot topic then in light of this growth has been inflation. Like economic growth, inflation is near 40-year highs as well on a year-over-year basis. Where is inflation relative, again, to prior to the pandemic levels? And then what is the longer-term outlook for inflation?
So we've certainly seen a lot of upward price movement, particularly in the last 12 or 18 months. And so with headline inflation running north of 7%, the Fed's preferred measure of inflation running the upper 4% range, that core PCE index, there's definitely a lot of upward price pressure. Now, the Fed is targeted for some time 2% inflation on an annualized basis. If we expand the window to the last 10 years, including this volatile period we've seen, we're at about 2.1% inflation on a headline basis over the course of those 10 years on an annualized basis. So in effect, we finally caught up to where the projections were for the last decade or so. Now, that of course doesn't take away from the pain that inflation causes to all of us in our wallets. Cost of food, cost of energy, cost of things that we buy on a daily basis are up significantly. And we still have some pockets of bubble inflation, like used cars, that are up 51% since the start of the pandemic.
That's sort of the transitory name we heard for a while.
Yep, that's some of the transitory pieces. Although we're seeing a lot of the inflation that in certain areas like food be more persistent or more permanent. Food is up about 2.3% on an annualized basis over the course of the last 10 years. That puts it right about on trend with where we expected to see. The uncomfortable part is we experienced most of that price change in 1 year, as opposed to metered out over 10 years.
Yeah. And one other aspect, that is potentially inflationary is wages, Jason, too. So, any comment there on rising wages and the inflationary pressures that may cause?
Definitely. You always see inflation and wages move in concert with each other. One pushes the other one in a certain direction. And we have seen for the decade or so before the pandemic, wages grew a little faster than inflation. That's normal. Normally, wages grow at a rate of productivity plus inflation. And we certainly saw that for the decade before. Now, wages have trailed inflation. So wage growth is annualized at about 6%, which is a lot. We were at maybe 3% before for a decade. If we continue to see wages move in the direction they're moving, they'll soon outpace inflation. As inflation starts to level off, wages would outpace them. And the risk we run into there is what's known as a wage price spiral, where the two of them keep pushing each other higher. We'd like at all costs to avoid that.
Yeah, understood. And the corollary to wages is employment levels. Yeah, Jason. So the unemployment rate and job growth figures get a ton of attention these days, and they're nearly back to 2019 levels after the pandemic. 2 years here. However, you've identified the decline in the labor force as a continued headwind for business, right? So, what sort of impact does the decline in availability of labor have on the economic growth and, again, wage inflation outlook?
Many economists in the Fed have long considered the 4% inflation, 4% unemployment level as full employment.
Right.
We were 3.9% a month ago. We ticked up to 4% last month. And there's actually a silver lining there because we ticked up to 4% because more people came back to the workforce. We've been pretty stagnant, though, with that labor force participation since about August of 2020 until last month. And we saw a 0.3% increase in labor force participation in the last jobs report that we got last week. It's important to know we're still about 1.2% behind where we were when the pandemic started in terms of labor force participation. We'll put 0.2% of that aside for aging of the population that we would have expected. We would have expected labor force participation to decline a bit. That 1% that's left represents 2.5 million American workers. Even if we take the BLS's upside assessment of 800,000 of them could be early retirees, those that are going to retire in the next 2 or 3 years and decide to just retire now anyway, you still 1.7 million workers short in the economy today from where we were at the start of the pandemic. And that obviously creates a lot more wage pressure as the competition for available labor heats up. And employers have to pay up for labor or to poach labor from their competitors. And That additional pressure on wage inflation is a concern to watch as well.
Agreed. And that discussion on wage inflation leads us right into our Fed discussion and monetary policy for 2022. So Nancy, you're patient. There's a lot of talk about the Fed raising rates and a lot written these days. First, before we get into the rate hike forecasting, can you just define what rate we're talking about, what the Fed funds rate actually is?
Sure. It's a great place to start, Tom. Thank you. So the Fed funds rate is actually the rate that the Fed charges the banks when they overnight lend or borrow money. Effectively, that rate has been at zero, so it's been kind of an easy money situation for us. The FOMC meets 8 times a year, and that rate will move as economic climates dictate.
Thanks, Nancy. It is helpful. And that brings us into the polling question. Before we give our predictions, let's hear what the audience has to say. So our second polling question is, how many rate hikes do you think the Fed will make in 2022? And we're pulling that up right now. Anywhere from more than 6 all the way down to none. So as soon as the guys have that, please take a moment here and make your selection. I think I have to make a selection just to get it off my screen.
Might have to ask you what your selection was after we hear what the audience had to say.
All right, I'll share it with you. Okay, so we'll come back to the audience in just a second. But Nancy, you know, the Fed has multiple levers that they can pull to help combat inflation while maintaining, hopefully, healthy economic growth. A couple of their tactics include, using the balance sheet, which we've seen, pretty aggressively they've used over the last couple of years. And the other is to raise or lower overnight Fed funds rates. So let's start with the Fed funds rate. Nancy, what is built into the market currently in terms of rate hikes in 2022?
So right now, the curve has priced in 5 to 7 rate hikes in 2022, 2 or 3 in 2023, and maybe 1 or 2 in 2024. It's very difficult, Jason expressed, very difficult to go further out and really be confident of where rates are going to go. But definitely 5 are priced in. The front end of the curve is very steep already from that being priced in. Also, the open markets is where they have been purchasing both treasuries and mortgages. They've been tapering that program, and the Fed has signaled that they will stop tapering in March and raise rates. And we expect a 25 basis point rate hike in March.
So sort of a double whammy, both
Yes.
the rate hike as well as the ending of the purchasing of out in the open markets. So in light of those actions, what effect does that have in the near term on the capital markets?
Sure. So like I said, the front of the curve is already steepened. So those rate hikes are priced into the marketplace. So we have seen higher yields on the 0, so the T-bill to the 3-year area of the curve. So immediately we have a higher rate. The futures market has already reflected that into our curve.
And Nancy, for your benefit, we've got that slide up that shows the steeper up front but flatter yield curve right now.
Right. So the intermediate, the 5 to 30-year part of the curve, intermediate to long, has flattened. And that makes sense because we don't really know how effective are these rate hikes going to be. Where's our economy going to be longer term? So we have seen a flattening of the curve, which indicates potentially a slowdown in growth or just cautiousness in the marketplace. We see a steepening on the front end of the curve, indicating that the Fed is ready to go. We're ready to go. We're going to raise rates, and we're off to the races. So
great. And generally, from a corporate perspective, corporations are in pretty solid shape these days in terms of their actions in the last couple of years, buying down, higher yielding securities in the marketplace. Is that fair, Steve?
yes, there's been very strong debt management on corporations. We've seen them call in the higher coupon debts. What that means is managing the higher rates on their own debt. So they've called back higher coupons and replaced them with lower coupons over the past 3 to 5 years, basically.
Stronger balance sheets than just a couple of years ago.
Yes,
It's a good sign
definitely.
for the markets, I would think. Okay, great, Nancy. So let's take a minute and see what the audience thought about in terms of rate hikes and compare that with what is priced into the yield curve right now. 3 to 4. is the number. 66% of the folks say 3 to 4, so a little bit more cautious. And really, 1 to 2 was the next largest category at 22%. So our audience is maybe not believing what the bond market is telling us and what the Fed is telling us. That, or they foresee other things that may change the Fed's current thinking. We talked about this before, Jason. What are some of the things that may change the plan of rate hikes over the next year and a half of the Fed?
Sure. And the one that obviously comes to mind because of what we've all experienced the last 18 months or 2 years, actually, I think I said we're entering year 3 now of the pandemic. If there is a resumption of pressure from COVID, and the Fed has already hinted in both November and December's comments that would be cause for them to pull back from their intended path. And the other one has emerged over the course of the last couple of months is geopolitical risk. We talked a lot about this before the pandemic. There was an event in the Ukraine then. There was also a trade conflict with the United States and China. We have a resumption of potential hostility between the Ukraine and Russia. If that comes to some sort of volatile conclusion, that could cause the Fed to take a pause from what they're doing. And then, of course, just a breakdown in economic data. We've certainly seen in prior cycles, whether Greenspan or Bernanke, the Fed react a little too aggressively initially, start to see growth pull back, and if the Fed sees that, they're likely to tap the brakes a little bit. We just don't want to get into a situation where the Fed is going gas brake, gas brake, gas brake. We all hate being in cars that drive that way, and we're going to hate being in an economy that moves that way too.
But this is a very data-driven Fed, wouldn't you say,
Yes,
Jason? So
very much so.
they'll be all over the numbers. Well, thank you for that. So let's dive a little bit deeper into the markets. One factor to consider is the degree of cash that has been accumulating on the sidelines in the last 2 years here, potentially as dry powder for investment, and that may act as a market shock absorber, despite these higher rates. So, Nancy, what do you think the increase in cash balances and the money supply means for the markets and potentially for inflation?
Yeah, I think just like you said, Tom, it's a great shock absorber in the marketplace. So we have a Fed that's stepping back. If you look back over the past 2 years, the open market, actually they bought corporates, they bought asset backs, they bought mortgages and treasuries. They really expanded that, and that supported the market. They have since pulled back from corporate and asset back purchases. And as they have said, the Fed has said they're going to stop purchasing treasuries and mortgages. So this leaves some extra supply in the marketplace. However, we do have a lot of cash on the sidelines. The Fed and government policy has supported both the consumer and the corporation. So we see a lot of cash on those balance sheets. M2, I think, has grown somewhere between 26 and 27% since 2019. And that's been the driving force, is this support from government policies in the Fed. Now, interest rates are a little bit higher, albeit they're still relatively low if you compare them over time, but they are higher, and that entices money managers and banks to reinvest into the marketplace.
Absolutely, we're seeing that, and insurance companies, others as well. So very, very interesting times, and we'll see how much of a rate increase is needed to entice people to put money to work. But again, that will offset these higher rates as that cash that could go into action. So thanks, Nancy. Jason, let's shift from fixed income to equities for a minute. But before we do, I'm going to ask the audience, just like we did with rate hikes, what do they forecast the equity markets to look like in 2022? So where do you think the S&P 500 finishes the year in terms of performance? We've got categories from up over 20% to down over 20%. So take a moment, if you could, to click on the radio buttons, and we'll compare your prognostications with ours. And let me click. Okay, so we'll come back to that. But Jason, we all follow the equity markets pretty closely, and we all experienced January's pullback in the market. What is your take on the current equity market valuations and where the broader markets may be headed?
Well, you mentioned January's pullback, and that was the first more than 5% pullback we've seen in quite some time in the broader market. Those are every year occurrences in a normal market. So it's sort of an abnormal period of time to go between 5% pullbacks. It's also been an abnormal period of time since we've had a 10% pullback in the broader market. So that could be on the horizon at some this year as well. Despite that pullback, though, we still view the equity markets as significantly overvalued, particularly at the large cap growth end of the spectrum here in the United States. Those stocks that have had market leadership, those momentum or volatility or growth stocks have had market leadership for quite some time. They've really run to some pretty stratospheric valuations. We may be seeing a bit of a pivot in terms of leadership in the market that we saw over the course of January, as there was a wide gulf in terms of disparity of returns between value and growth stocks, nearly 10% wide in some capitalization ranges.
And do you see that persisting? I mean, we've seen sort of a pretty rapid swing, Jason. Is that something as you look forward, you would expect to continue in light of where we are with rates and the economy and the business cycle?
Yeah, we believe we've seen kind of the first steps in a regime change in the market.
Okay.
We've been under this growth regime for quite some time. As we move from recovery to expansion in the economy, you typically see a movement from growth to value stocks. And those value stocks are, think of your old economy companies that produce cash flows, so industrial companies, financial services, less the technology companies and those that are out on the bleeding edge. Also, in a rising rate environment, that does favor value stocks over growth stocks, where those future cash flows our intended future cash flows of growth stocks are compared against current cash flows of value stocks. And those are more valuable to investors in the current environment.
Speaking of equities, international, small cap, can you just speak to those two asset classes as well?
Sure. As we move in capitalization from large cap to small cap, your sensitivity to the local economy increases. So whether we're talking international, US small cap, they're a lot more sensitive to what's going on in the local economy or the national economy as opposed to the global economy. Whereas your large multinationals can move risk around across the globe. International stocks, though, they're advantaged in the current environment a couple different ways. One, they've not seen the valuation improvement that we saw in US growth stocks. So they sit a little bit less richly valued than US stocks. That's attractive from that perspective. They're also, from a composition perspective, international markets are made up of a larger percentage of these value stocks. There's a larger percentage of financial service industrials in international markets. That bodes well for international performance, which has actually underperformed the US for a decade. That those cycles usually run at about 7-year increments. We're about overdue for an international resurgence on those metrics as well.
Great. Okay, thanks, Jason. All right, let's go back to the polling question and see how the audience fared with respect to their predictions on the S&P 500. Okay, a little more balanced here. So up 5 to 20%. And up or down less than 5%, both were 41%. So 82% of the folks say between up 5% to 20 or up or down less than 5. So kind of in the middle of the histogram there. Only 1% up over 20%. So not a lot. Not
Only
a lot
1% of extreme optimism.
Yeah. And same thing on the downside. So kind of in the middle here, but some optimism. It looks to me in the audience. All right. Well, thanks, Jason. Nancy, let's talk about the state of the fixed income markets, which, is the topic of the day. And what have you seen in terms of recent performance of fixed income? And give us a little insight on the various, security types within fixed income and what's going on and what you see going forward.
Sure. So first of all, as in the equity market, the fixed income market has been higher volatility than normal. Rates are going up, so that means dollar prices are going down. There's questionable about, is it 3, is it 5, is it 7 rate hikes? So there's some unknowns, and that has caused risk spreads, anything that's not a treasury, to widen or cheapen. So we've seen corporate credits. I think they're trading around 110 on the index now. They got into the 80s about a year and a half ago. So we've seen 2 years ago. So we've seen some decent amount of widening and cheapness there. Mortgages with rates going up, that kind of helps on a prepaid basis, but we still need to have confidence that buyers will come in and purchase these securities. So we've seen some spread widening there as well. So wider and more volatility has been kind of the recipe of the day.
And you see some attractiveness in corporates and mortgage backs as well, right? Both of those areas, a couple of nuances.
Yeah, so dislocations in the marketplace is what we we look for. We look for those opportunities. When we're in a rising rate environment, as I said, your dollar prices are going to go down. So our goal is to protect your principal. And we have several tools to do that. One is duration management, where we're going to place cash flows in the portfolio along the curve. And the other is credit risk management. So we have seen spread widening. So that means that as you go up in credit, most of our investments are investment grade. So BBB would be your lowest credit rating you can absorb. We find value in single A's. We think the longer end of the curve going up in credit is a great thing to do. You're getting paid for it for first time in a while, and you have strong balance sheets. We've seen corporate America be pretty resilient to the whole economy here. So that looks like a positive place versus having interest rate risk at the long end of the curve. So it's curve placement, cash flow, and duration management is what we're finding.
Excellent. Okay, great. Well, thanks, Nancy. Let's shift our attention to investor considerations in light of all of this. The markets are clearly not behaving like they did during the depths of the pandemic. We're seeing maybe more normal volatility, Jason, to your point, in the equity markets, but certainly sector and style rotation, in some cases risk aversion in the equity markets. Jason, what is your general investment philosophy, and then what do you tell people in times like this?
Sure. And when we talk our investment philosophy, it's important to note that we are very much aligned with long-term investors. We are not short-term traders in our client portfolios. So that's an important understanding. We're also very focused on goals. A goals-based investing approach often doesn't align with purely just grabbing every last bit of return you can and trying to beat an esoteric benchmark. It's more about successfully achieving goals over the long term. That especially in an environment like we find ourselves today with higher levels of volatility, lends itself to risk management and managing risk within portfolios. So the environment we find ourselves today, we think is pretty challenging. And for your average investor, we tell you to stay the course, to use a long-term financial plan and pretty clearly align your portfolio with that plan. But also understand that it's a more volatile environment. There's going to be some more volatility as we move through this.
Yeah. And despite what you talked about earlier, stretched valuations in a number of areas, you're not saying get out of the markets. This is, we're long-term investors. You need to stay exposed to equities, but you leverage advisors, active management like yourselves to find those places where there are opportunities and there are valuations that make sense at this level.
Yeah, absolutely. I always like to say time in the market, not timing the market. That's what matters. And staying in the market in this type of environment, again, focused on risk management. Tommy touched on active management. There's a few periods of time where we're going to pound the table as hard as we're pounding it right now for using an actively managed approach. And that's both in terms of asset allocation, but also in terms of individual security selection and managing portfolios. And I don't think there's an area of the market where pounding the table harder for active management than in fixed income for some of the reasons that Nancy's touched on, but I'm sure can expand on more.
Teed it up for you, Nancy.
Sure
What do you have to say?
Thanks, Jason. Well, our fixed income team also has a long-term philosophy, and our philosophy is to out-yield our benchmark. And so there's different ways to do that. It's security selection, it's asset sector selection, or duration management to achieve these goals. So at this time, being that we're in a rising interest rate environment, we feel we have a lot of interest rate risk out there. So at this time, we are overweight credit risk and underweight interest rate risk. So what that means is obviously we're overweight credit, so corporate credit. The benchmark, I believe, is around 25% in corporate credit, and we're carrying about 50%. Usually our maximum is 60%. So we do have a little bit, powder to, re-enter markets when we feel like spreads are justified. And then we're underweight interest rate risk. Say that 3 times fast. So that means we're underweight treasuries and we're underweight mortgages. We're underweight mortgages on both a percentage basis and a contribution to duration basis. While the way we manage that is we look at structured products, CMOs, agency CMBS, and asset backs fall into that category. And within the mortgage coupon stack, we like to look for what we call story bonds. We like higher coupons. Higher coupons have a lower duration rate. Interest rates are going up, so prepays. You're not going to pay your mortgages fast, maybe going forward. So we kind of like that story. But we also look for things like high LTV bonds or low loan balance, rural bonds, mobile homes, public Indian housing authorities. These are nice prepays that are very steady and generally reliable in the marketplace, predictable.
Yeah.
So that's where we focus. But again, we're still underweight, and we're also underweight on contribution duration, meaning our cash flows on the curve are shorter than the benchmark.
Well, in listening to you, it's clear active management by experts is really a differentiator because you can't just buy the benchmark and succeed in this environment.
It
So,
really is. It is. It's important, I think, to look at the benchmark. We're 25% corporates, so benchmark roughly likes 25% corporates, 45% in treasuries, and maybe 30%, a little bit more, 35 in mortgages. So that is a lot of interest rate risk. And I think it's really important to have active management. You don't want to just accept that interest rate risk because you're going to lose principal.
Yeah, well said. So Jason, in light of both of these conversations, you as the head of our multi-asset strategy group, lead the team that does all of our asset allocation. So what are you recommending these days in terms of shifts in the year ahead?
So we just completed our capital market assumption process, resetting our assumptions for asset classes for the coming year. And we think at both an equity and fixed income basis, those broad asset classes, it's a very challenging environment. And we aren't expecting returns we've seen in years past to repeat themselves in the coming 3 to 5 years. We also think volatility is going to be a little elevated from where it's been historically across most asset classes. What this leads us to is to further position portfolios. We started positioning portfolios for a rising inflation environment early last year. We're continuing down that path this year and adding in positioning for a rising rate environment. So what does that mean within portfolios? We are looking at investing in real asset areas. Real assets for us is global real estate, commodities, and infrastructure. Those securities that are associated with those asset classes. Those weights likely going up in many of our client portfolios. At the same time, we're reducing some volatility. So both U.S. and international small cap, since they're so tied to the national economy and have higher levels of volatility anyway, we're lightening up exposures there to control risk and volatility within portfolios. And then finally, and sorry, Nancy, we're lightening up our exposure to core fixed income. Despite the preference for active management, the rising rate environment is a tough one for bonds, as Nancy pointed out. Yields go up when prices go down. So we want to make sure we're not overexposing clients to those assets. However, it's important to say we are still keeping healthy allocations there. That is still the safe asset, and that's your rainy day money. And a balanced investor or an income-focused investor, it's still important to control volatility through the use of fixed income.
Yeah. And Jason, you guys have been positioning portfolios for this for a couple of quarters, right? So are you saying that you're going to even go further down this path?
Yes, that's correct. We started positioning for inflation early last year, adding meaningful weights to commodities, increasing weights in infrastructure, both based on the infrastructure spending bill and their reaction to a rising rate environment. We're continuing down that path this year because we think inflation will persist, at least in the short term, the near term viewpoint of the economy.
Yeah, okay. Great. Thank you, Jason. Nancy, I'll shift back quickly to fixed income. What areas are you most concerned about, and where do you see opportunities sort of specifically within the fixed income space?
Sure. So portfolios right now in our corporate credit bucket, we are not, I just want to mention, we are not sector rotators. We are just looking for strong balance sheets across all corporate sectors and where we want to be on the curve. So that being said, we end up being overweight financials. And that's generally been true the last 5 years. From the last recession we went through, we really saw banks clean up their balance sheets, and they're very strong. Also, higher interest rates are a positive for banks. So that sector, it's natural for us to be overweight, and we continue to be overweight that sector. Also, the energy sector, we're overweight. We think if you just look kind of a big picture, so specifically getting into energy, but we've been in a lockdown and a pandemic, and the consumer has been more good driven with their demand instead of service driven. So once we come out of this lockdown, move from pandemic to endemic, we believe that you'll see more demand towards services. and energy therefore will be used. Our concerns are, again, interest rate risk. I couldn't pound the table more about that. And we do take mitigated risk in those sectors that are treasuries and mortgages to try to find the best cash flows that we can. I guess some of the risks would be, as Jason spoke to already, the geopolitical risk. Is the Fed behind? I hate to say the word recession, but if we saw a curve invert, it could indicate that there is a recession. So that would be a surprise event at this point right now.
Excellent. All right, thanks, Nancy. Jason, you hit on most of these, but any other comments with respect to the equity markets in terms of where you see risk and opportunity?
Well, I touched earlier on the growth value dynamic. It's important to underscore that with just kind of broad factor exposure across equity markets, whether it be growth, momentum, value, dividends. It's important to have a very diverse exposure to factors in this type of environment. Things can turn on a dime and you don't want to put all of your eggs in one basket. So that's an important approach to managing an equity portfolio that we're cognizant of in this environment. I mentioned the real asset piece. It's attractive to us for a number of reasons, both fundamental and macroeconomic. And you heard me mention international earlier, that like our US exposure is shaded towards the larger cap end of the spectrum that is less volatile than the smaller cap end.
Jason, I'm going to just hone in on one thing that is a little different, I think, from your team is a lot of people feel pure real assets and think about commodities, but you actually look at what you call infrastructure as almost an asset class, right? Can
Yes.
you just spend a minute talking about that?
Yeah, so we break real assets into three buckets: global real estate, and we think there's room to run global real estate. US ran significantly last year. Commodities, which is your typical commodities, whether they be oil and gold or some of the smaller softs or other metals. Infrastructure we break out as a separate category. Infrastructure is things that are highly cash flow producing, so assets that producing cash flow. And it's a global asset class for us. Here in the United States, we often think of infrastructure as utilities, but things like toll roads, airports, and seaports are offered as investments across the globe. You can invest in Australian toll roads, for example, or German airports. And those things are beneficial in an environment, a world waking up to maybe a new normal or maybe a return to normal, but also with the amount of infrastructure spending that most of the developing world is committing in terms of the broadening expansion in economies across the world, they're beneficiaries of that as well.
Yeah, and from a correlation standpoint, help you put it all together in a nice diversified.
They do, and they're a lower volatility asset class as well. There's less impact from the day-to-day gyrations of the market.
Thanks, Jason. One other sort of question that came up was, what about bank customers? They're thinking about a rising rate environment. Any thoughts for our prospective borrowers out there?
Well, for those of you that are sitting at variable rate, please, bankers who are watching this, don't come hunting for me after this. But if you were going to lock in a fixed rate, the bus has already left the station, but you got a bit of a chance to grab the bumper before the Fed acts in March. You have weeks, not months, to act on that theme. If you are thinking about hanging on to your variable rates and hedging, it's important to note a hedge is a reduction in volatility. That's the goal. It's not simply my hedge was right or wrong. So it shouldn't be measured on, did you have to use the hedge and was successful to pay off? It should be measured as, I can sleep at night because I have constrained the amount of volatility or range of outcomes.
Like insurance.
Exactly. Think of it more like insurance.
All right, good stuff, Jason. I think we have time to squeeze in a couple of questions from the audience. So I'm going to just put this one out probably to you, Jason. How much does the supply chain issues we keep reading about factor into inflation? So how much of it is supply chain? How much of it is more than that, and more permanent, potentially pricing?
Sure. It's hard to slice the apple to say exactly how much is supply chain versus how much is more persistent inflation, but we certainly are still seeing, particularly on the producer price side, a lot of price push from supply chain issues, whether that be chips that have gotten a lot of press and been a limiting factor to a number of things, or just catching up to the excess demand. There's a lot of excess demand in the economy right now. It's a key tailwind for us in 2022 for higher than trend economic growth, but it also creates pain on the producer side because it continues to exacerbate the supply chain issues. If you're waiting for furniture, for example, the sheer amount of demand that's out there means furniture producers, which likely aren't waiting for chips, unless you're buying smart couches. You're still waiting on capacity to come back online. One encouraging thing I will say is relates to supply chains, and we saw this in December. We saw it in the fourth quarter in the GDP numbers. Retailers, distributors, producers have been happy to take a gap in demand and fill it with inventory management. So they're restocking inventories. And that's an encouraging thing to see in the GDP numbers, because it means the health of businesses is there and they're willing to step in and fill in any gaps in demand with increasing inventories, which can only help us emerge from the supply chain as we move through this year.
Okay, great, Jason. This is probably for you too, Jason. The question was the impact of the US dollar. What will it have on international stock values? And what's the projection for the US dollar? So you talked about, international stocks being haven't had the run up that we've seen in the US in the last couple of years. So valuation wise, they look a little bit better. But if you're a US dollar investor, how does that impact, that investment outside of the US?
Obviously, your international emerging market exposures, and Nancy, feel free to jump in here too, they're going to be impacted by the exchange rate of the dollar. As the dollar strengthens or weakens, it's going to be relative to those local currencies. So it's hard to say the dollar in a basket against every other international currency, because we've certainly seen periods over the course of the last few weeks even, where, for example, the yen has held up its value against the dollar, whereas the dollar's weakened against the euro. That occurred last week, and we saw some pretty meaningful increases in European equities on a dollar basis on the back of weakening. Now, earlier in the year, you saw some strength emerge in the dollar, and that is going to influence returns. And I think the underscore here is, instead of saying there's an absolute direction that we're going to plant a flag on the direction of the dollar, I think you can include this in the bucket of volatility. That on a period-to-period basis, because central banks are somewhat diverging in policy at this point, they're all stepping back, but to very differing degrees, you're going to see some more friction emerge in currencies. And that's an important consideration in international investing, and even more so in the fixed income space, where tighter yields in international securities mean currency movements can have a much greater impact to the end investor's result.
Yeah, and again, as you said before, Jason, if you talk about equities, it should be a longer horizon that you're looking at. So whether there's some, quarterly or annual issues, this should be a long, 5 to 10 plus year investment. So you'd be thinking about not just the 1 year currency risk, it's really a longer term investment. And that's why the valuations are relatively attractive, I would agree. I'm going to ask one more, and I'll go to Nancy. This is a question about bond funds. So the question was bond funds versus individual issues that are held to maturity. Which is better for an individual investor?
Well, I think it's your appetite for risk. A bond fund, if it's actively managed bond fund, I think that's way better than just putting your money in an index or an ETF. Individual bond investing, I think if you have an expert that could put their pencil down and really dig in and look at the credit, it's a great time. It's a great time. I think it's interesting. So during the pandemic, we saw a decent amount of investment grade corporate bonds get downgraded into high grade. Now there's been a lot of support from government and corporations, and we're coming out of this, and a lot of them are ready to get upgraded. So if you have an expert that can do the credit work and pick these rising stars out, it's a great opportunity for individual investing.
Thank you, Nancy. Okay, we're a little over time, so I'm going to call it here at 4:46 or 4:47. Thank you all for joining us today. Thank you to Nancy and to Jason. As previously noted, we'll be conducting these panel discussions every quarter. So our next one will be in early May. In the meantime, you can follow Jason's thinking on the economy by reading his weekly market update, which you can see by following Wintrust Wealth Management on LinkedIn, or requesting your Wintrust relationship manager to send you a weekly email with the update. And finally, a recording of today's event will be available on Wintrust's YouTube channel, as will a transcript on our website. So thank you again. Have a great rest of the week and stay safe. Nice job. Was it fun? Good job, Jason.